Hello everybody, welcome to another episode of Erickson TV, courtesy of Lauren. Hello Lauren.
Hey everybody.
And we're continuing now with our part 2 of our year-end 2012 series about USA Today's 13 investment themes for 2013. So if you haven't seen the previous episode, please go back into our website and find that episode because it kind of introduces what we're talking about. But we've done the first 6 and we're going to do the last 7 of them.
Yeah. And USA Today didn't do well in their first 6.
Yeah, they were we figured out they were 1 for 6 on the first 6.
And only a partially 1 for 6.
Okay, so this one, number 7, is beware of a housing stock correction. So that what I think they're basically saying is that housing stocks have had a great run in 2012, but they could be vulnerable to a housing correction. So be careful if you're invested in them.
I don't even understand.
Again, I think we would both agree that that's wrong because your market timing based on some prediction of a future event.
Right.
Right.
And yeah, to address the specific point though, if housing stocks really did have a great year this year, and I don't even actually know that they did. Right. I'm not sure that their information is even right. But if they did, it's probably only because they got sort of too undervalued in previous years. So that there's no reason to worry about. Well, what happens this year doesn't affect what's going to happen next year.
Right.
I mean,
yeah, the way that we manage portfolios, pretty much every sector is in there. So, so we would never say specifically exclude that sector because we think something's going to happen. Okay, number 8, score profits with fast-growing internet names.
Oh, it's 1999 again. I'm glad we're back to this idea. You know, we own the whole market, and I think that we'll score profits with whatever fast-growing names they are, no matter what they are, because we tend to focus on owning very small stocks. And those stocks, even though you can't predict which ones it's going to be, a very small number of those small stocks will be the big earners that drive stock market returns in the future. Right. So I wouldn't suggest picking internet stocks or any other kind of stocks. Invest in the whole universe of small stocks.
Yeah, which is the safer way to do it.
Yeah, exactly.
The number 9 is avoid stocks with regulatory headwinds. So basically, they're saying get out of stocks that potentially could have some change based by state laws or federal laws or regulations that might crimp their ability.
Yeah, this is just selling fear.
Yeah.
I mean, it's like there's always regulatory headwinds, and there's always going to be.
Right.
That doesn't. Yeah, that's just pure fear right there.
Okay. This one I think I like. This is say go long on global recovery, and what they're basically saying here is that given all the gloomy business news, it says this is what I don't like about it. They said invest because it was a more profitable trade. Will likely bet on a global economic recovery. So basically, they're saying then they start going into focus on metals and mining, as well as the energy sector because these could be the sleeper hits. So basically, the headline's pretty good, but then you start digging into the detail, it's terrible.
Right. Well, we agree with global investing.
Yeah. Okay.
So since we don't want to pan every single thing they say, we'll sort of say we agree with that one.
But we're long on everything.
We're long on everything, right? So.
Okay, hop on the housing recovery. Now they contradict themselves.
Yeah, well, of course.
Number 11. So I don't think we need to say anything. In one article, they contradict
themselves. Yeah.
Okay. Number 12. Buy into the U.S. manufacturing renaissance.
Well, I mean, the only positive thing I can say about that is again that this is a reason why we hold stocks for the long run is that industries come back.
Yeah.
And they do. U.S. manufacturing has come back. That's the truth. Which people thought would never happen.
And they might be value companies, some of them. So
that's true.
Fits well in our indexes. Yeah. So that's good. Last one I think I like is diversify bond holdings away from U.S. Treasuries. Well, maybe I don't like this. Let's talk about this one. They say that because yield on government bonds remain near record lows, to reduce the risk, investors should diversify by investing in many different kinds of bonds, including high-quality corporate bonds, emerging market bonds, and municipal bonds that look attractive. So maybe that's good advice.
Yeah. Well, we do invest in international bonds.
Right.
Some of the stuff they listed there, I would really not recommend. I don't think anyone should invest in emerging market bonds.
Yeah. So that's partially good. So I'm going to give them of the 7, maybe 1 out of 7.
1 out of 7.
Okay. So 2 out of 13.
2 out of 13. Yeah, not very good.
Okay.
And notice that they even contradicted themselves pretty blatantly in the same article.
Okay. So that's good. So so I want to end this with wishing everybody a happy New Year. Lauren, I think we agree that if people are worried about what to do for 2013, there's a better way of strategizing. This is not good advice.
Right, yeah, exactly.
Thank you very much. Have a great New Year, everybody. Find out.
See ya.